Welcome to Chapter 5, where we continue fundamental analysis with financial statements and ratio analysis. Now, relax, you folks, you accounting students, don't worry. We're not going to do any journal entries or trial balances, or we leave the accountants to do that for us, and we are forever grateful because if an accountant's spouse cannot sleep, all he or she has to say to their spouse is, "Dear, tell me about your day at work." Yeah, don't worry, we'll insult everybody by the end of the semester. But we are, as we said, eternally grateful for the work that the accountants do. And the more accounting we take and have, actually, the truth is, the better our off we will be with understanding the businesses, stocks that we're interested in investing in. So let's start on slide number 2 with the financial statements. There are 3 financial statements that publicly traded corporations must uh, present to the world through the Securities and Exchange Commission every quarter. They are the balance sheet, the income statement, and the cash flow statement. Now, don't get the cash flow statement confused with the cash flow statement that we learned if you took the BUS123 Principles of Money Management, Financial Planning, and Money Management, as it used to be called. No, 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 no. They are 2 very different things. In fact, the accountants cringe when we use the term cash flow statement for what is essentially an income statement for a personal financial situation. We are going to use the balance sheet from the accountants, which is the financial summary of a firm's assets, liabilities, and shareholders' equity at any given point in time. The income statement, what we call the cash flow statement in the Principles of Money Management class, which is the summary of the operating results of a firm covering typically a year or 3 months. And then the cash flow statement, which is essentially what happened to your checkbook. Where did the cash come from? Where did it go? This is a financial summary of a firm's cash flow and other events that cause changes in the company's cash position. Again, quarterly, annually. And as we said, the more we know and understand accounting, the better we will be able to understand and analyze the companies we're researching. And thankfully, we don't have to do any accounting. I took accounting a long, long time ago. I actually did okay, but I just said I'm never going to do that again if I don't have to. Slide number 3, the balance sheet, the snapshot. The balance sheet shows us the assets that the corporation owns and the debts that it owes. What are the liabilities? And whatever is left over is called equity. We called it net worth in the financial planning class. It's the same idea. What is left over after we subtract the debts, the liabilities from the assets? And the formula that we typically think of is assets equals liabilities plus equity, but typically the one we think of is assets minus liabilities equals equity. But the formula that the accountants think of is assets equals liability plus equity. It's the same thing, folks, but it's just a different way of showing it. We tend to think of take your assets, subtract your liabilities, that's what's left over, equity. The accountants say, no, 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 no. The assets are equal to the liabilities plus the equity. Of course, the equity is what we own, but the liabilities are somebody else's assets. We owe it to them. Now, as we've said, accountants do things a little differently with regard to time frame, and what they do is they take anything that is going to be consumed within a year to be the current assets. So their time frame is 1 year, and they call it current assets. Anything more than a year is long-term assets. Now, that's not how in finance we think. We think long-term, 5, 7, 10 years. But no, the accountants go from 1 year current assets and then long-term assets are anything greater than a year. So let's take a look at a balance sheet example. Here is the balance sheet for Sprouts Farmers Market. Now, interestingly, this class is taught in San Diego, California, Chula Vista, specifically south of San Diego. And of course, it's available throughout the world, and you get people from all over the world contacting you. One gentleman is in New York, and he thought that Sprouts was a phony company. He didn't think it was a real company. No, it is a real grocery store chain. It's similar to Whole Foods, but it's publicly traded, whereas Whole Foods is owned by Amazon, and it's a little bit big. It's actually much bigger than a Trader Joe's, but same sort of market, target market, whole, better, more high quality, healthy foods. But Trader Joe's is also privately held by a company in Germany called Aldi. So this is actual real company, Sprouts. And we see at the end of 2022, they had substantial assets, 295 million. Notice it says all numbers in thousands of cash and cash equivalents, which means they probably owned a lot of commercial paper and other short-term investments. And it's in thousands. So it's 295,190,000 accounts receivable, inventory, other current assets. What are these things? You would learn more about them, of course, in an accounting class. And then those were the current assets that are going to be used up within a year. And then long-term assets, long-term investments, plant, property, and equipment, intangible assets, sometimes called intellectual property and the like, are quite substantial. And so their total assets were $3,466,000,000. And then what we need to do is just deduct these liabilities. Here are their current liabilities. These are the things they have to pay within the year. Long-term debt that is coming due. Accounts payable, money we owe others, and then any other current liabilities of 522 million. And then look at the long-term debt. Look at what happened between 2018 and 2019. Why did that happen? Well, because of the Tax Act of 2017, they decided, hey, look, interest rates are so low. Let's load up all this debt on ourselves. But notice that they still have plenty of assets, though. They still have plenty of assets to pay off their debts. And then here's what's left over. You take this number minus this number, and you get approximately this number. There's a little bit of round off error and the like. This is mostly educational purposes. I took these are actual numbers, but they're a little fudged because different sources will have different numbers. And what I've done is basically taken an amalgam from Yahoo and MarketWatch and other sources and made it more educational so that it's easier for us to begin with, because I'm not an accountant and I'm not about to go try to make it perfect. The accountants get paid good money for that. But you see, we take a snapshot. We take the assets minus the liabilities, and that gives us what's left over, the stockholders' equity. And we chart that through time, 2018 to 2022. All right, so back to the presentation. Let's now go to the next financial statement, the movie, the income statement. The income statement is sometimes called, some old folks will call it a profit and loss statement. This is what we call the cash flow statement in the financial planning class. You take your income, and that's the difference between the company's revenues and expenses used to pay dividends to stockholders or kept as retained earnings within the company to finance future growth. The net income is equal to our revenue minus our expenses. So what came in the door and what did we have to pay? We will take a look at an income statement, but before we do, let's just say that some income and expenses are not always received or paid for in cash. Huh? Well, that's where the accountants come in and try to explain things like depreciation. But before we do that, let's go to the income statement. Let's see if I can pull this off. Come on, sweetheart. I got to be nice to my computer because I'm sometimes, yeah, there it is. There's the income statement. Okay, and this is again showing us through time. Last year, 2012, what came through the door? 6 billion 400 million dollars. Notice we really should have more precision here, but I just took these from different four sources and sort of made a little amalgamation. And so the top line number, you might have heard that term when you were listening or sitting in on the earnings reports. The top line number is 6,400,000,000. That's how much money came in through the doors of Sprouts Family Markets. But how much did it cost us? In other words, they didn't grow all the food and they didn't make all the milk and all the other stuff that they sold. So that's called cost of revenue, or sometimes called COGS, cost of goods sold. And so we get a gross profit. Then we take our operating expenses. Remember SG&A, sometimes called just sales and administrative, or sales in general and operating expenses. And they just throw out these terms like everybody knows them, SG&A. So yeah, they got to pay the rent, right? They got to pay the workers and everything. And some companies need to put a lot of money in research and development. And so those were the total operating expenses. So you take that gross profit minus the total operating expenses and getting operating income. And we're going to use these numbers when we do some ratio analysis later on. And then there's a few other expenses that we need to deal with. Earnings, we create this earnings before taxes and interest. Here's a little bit more income. They just call it other income. Then there's the interest expense, how much we had to pay for our debt. Income before taxes, income tax expense, and then finally is our net income. Now these guys, notice any extraordinary items or other effects of accounting changes. Normally we don't really have those, but we include them. Notice they're all blank. So the bottom line number on Sprouts Family Market is $261,160,000. So you remember the top line number that we talked about? How much income, how much money came through the door, sales, revenue, and the bottom line number after we paid for the goods sold, after we paid all our employees and the rent and all the other stuff, and then all some interest charges and income tax charges. That's the bottom line. Last year, we saw that Sprouts Family Market had earned over $260 million. And what you notice, and this is something that many investors look at, is what's the trend? How are they doing? Well, back in 2018, they had only earned $158 million, and then 2019, 149, and then all of a sudden, what happened in 2020 and 2021? COVID, right? People didn't go out to eat anymore. So they had to go out and buy their own groceries and make their own food. So their income shot up, and you notice their top line numbers shot up, and their bottom line numbers shot up. And then it kind of modulated a little bit in 2021, but still respectable earnings and respectable income and respectable earnings. So Sprouts Family Market seems to be, by what we see on their balance sheet, doing pretty darn, on their income statement, doing pretty darn well. But as we've said in the past, I'm a big fan of dividends, all right? That's the one number we know is true because they paid it to us. All these other numbers, as in the case of some famous fraudulent activities like Enron, all these other numbers could be total borscht. Now, we probably could make sure that the income tax was correct because that's probably public knowledge at the IRS, but still, they are required to file these statements every 3 months, and if they're fraudulent, they could go to jail. Before 2002 or so, when Enron was discovered, uh, it wasn't that case, and the executives of Enron got before Congress and said, "We don't know that there was fraud going on." It's total bull. And the one exchange was totally was it brought belly laughs to the Senate when Senator Barbara Boxer, who used to be our senator in California, asked one of the executives, "Look, sir, where did you?" After he had said, I didn't know," and sir, where did you go to? Where did you get your degree from? Where did you get your MBA from? And he said flatly, Harvard Business School. And the room just broke up with laughter. Like, yeah, this guy doesn't know what's going on, right? And sure, so now there's a law that says if you are the one of the muckety mucks at the higher level executives, and you sign off on these things and they're fraudulent, you could go to jail. You can't just plead, "I didn't know." You have to know. It's your job to know. Okay, now here it gets a little tricky, and this is where the accountants come in. Some of the income and the expenses that we received or paid for in cash were not actually received or paid for in cash. Huh? How could that be? Well, there's one that we'll key on, but there are others. And that's why we have the cash flow statement. So the cash flow statement is essentially what happened to our checkbook, right? Where did the money go? Where did it come from? So it's older term, you don't hear too much anymore. A statement of cash flows. Cash flow is income realized in cash form, but non-cash items, cash flow is the income that's received in cash form. In other words, how much money did we actually make? Even though we might not have reported it as income because of certain deductions and the like, but we still received that cash. Non-cash items are income and expense items that were not realized in cash. And the same thing is true for operating cash flow and not operating cash flow. Now, what's the poster child, the typical example of this? Let's take a look. And that when we take a look at the cash flow statement, what we see is we start where the income statement ends. We start with the net income. Okay, that's how much you reported to the IRS. Great. How much did you really earn? How much cash did you really bring in the door or have left over after everything was said and done? Well, the poster child for this situation is depreciation. Depreciation, if you've taken the accounting classes, is an expense that you get to reduce your taxes. You reduce your income, which of course reduces your taxes. But you don't write a check to depreciation. It's an accounting transaction, and I don't want to get into it. You take it in an accounting class, but think about it. When you buy a car and you want to deduct that for your business, the IRS doesn't let you deduct the whole thing in 1 year. You have to depreciate it. You have to deduct the price of the car, the cost of the car over several years. Well, actually, not that many. I think it's only 3 or 4 years, right? But if you have a $1 billion plant, factory, you can't deduct the whole $1 billion in 1 year. You have to depreciate it. You have to deduct it over time. So the money's already out the door. You usually with bonds or whatever you bought, you got a mortgage, you took a loan. But however you paid for it, that's not important to the accountants. It's not important to the IRS. The IRS wants to say, okay, you paid $1 billion for that fabrica, for that factory. Over the next 20 years, you're going to be able to take, however much, what was that, 50 million a year over the next 20 years. And so that's why the first thing we do in the cash flow statement is we add back in whatever depreciation Sprouts Family Market claimed on their income statement because it allowed them to reduce their taxes, but they didn't actually pay $244,180,000 in depreciation. And then the same is true for all these other items. They are items that don't go on our income statement and are not included in the calculation of how much taxes we owe to the IRS. But when all is said and done, we see that after all the dividends, well, they didn't pay any dividends, but borrowing and purchasing back of stock and capital expenditures and all that other stuff, their checkbook last year went up by a little over 48 million. And that's very different than the year 2021 when it went up by 400 million. And then in 2020, it actually went down, even though they had record earnings. They had made some serious purchasing. And so their checkbook actually went. They paid off a lot of debt there, $400 million in borrowing. So this is the amount that the checkbook went up or went down. So you see how it's different, and we're going to use that idea. We're going to use the idea of, okay, how much is the earnings and how much is the cash flow? And if you remember the value line, there were two lines, one for earnings and then one for cash flow. That's why. And you often see that the cash flow was higher than the earnings. Why? Mostly because of depreciation. Make sense? And if this piques your interest and you haven't taken accounting yet, you really should, because the accountants really do have an advantage when it comes to cooking the. I shouldn't say use the word cooking when it comes to let's say processing the numbers. Food with a food processor or a Cuisinart, they really know how to massage the numbers. And I'm always in awe of Professor Martinez Sanabria, Maria Martinez Sanabria. She's on our staff, and she's absolutely fabulous. And she won Teacher of the Year once. All the students loved her so much. Have you ever heard of an accounting professor winning the Teacher of the Year award from the students? It just doesn't happen, folks. But it happened at Southwestern. So, and when I see her play with the numbers, I'm just always in awe. So take a class with, and we also have other, I'm not trying to single out, well, I am singling out her, but we also have other very high quality accounting professors. So don't think you only have to take Professor Martinez. Okay, so that was the cash flow statement. Next, where do these live? Well, every quarter and every year, the publicly traded companies must file a 10K annual report and a 10Q quarterly report. I think I've already played this game with you, but in the face-to-face class, I say, "What is that? 10K? What is that?" And they go, 10K. I say, "What's the quarterly report?" 10Q. And they yell at, I say, "What's that?" 10Q. And I say, "You're welcome." I get such a kick out of that. And I probably already told you that. My apologies. Anyway, because of the internet now, the Securities and Exchange Commission has created what's called Regulation Fair Disclosure, FD. Because before Regulation FD, often analysts on Wall Street would hear presentations or watch presentations from companies, and they would often get information, maybe not fully, baked and processed, but often get information before the general public would. And the Securities and Exchange Commission said, no, we shouldn't really allow this to happen. And luckily, the technology of the internet came along at just this time. And so now companies are required to make the public disclosures of material information fairly. So this is what you've done when you went, if you did it live, you were part of this. But if you did a recording or afterwards, that's what these earnings calls are. We're going to, we're Procter & Gamble on 9:30 or 4 o'clock New York time. We're going to publicly disclose all our information. So they schedule an earnings call, and then boom, the stuff is sent out to the world all at the same time, and you can tune in and listen to the CEO and the CFO and other people talk about the quarterly or annual earnings. Before that, though, you will find certain websites and certain services that will give you the whisper number. The unofficial sources that say, oh yeah, Procter & Gamble's going to increase their earnings by 30% this quarter. Well, they don't know. Maybe they do. Maybe they got some inside information, paid off somebody, but probably not. They're just guessing. And so, should you pay attention to the whisper number? Well, I don't think so, right? Don't play the whisper number game. It's just pure speculation. And, there are times when that's what moves the stock. They were supposed to increase their earnings 30%, but they only increased their earnings only 20%, which is still pretty darn good. And yet the stock tanks because people expected them to increase at 30%. Long-term, prudent investors should not bother with this game. A gentleman by the name of Nick Murray wrote some very good books, mostly for representatives and stockbrokers and the like, financial representatives. Registered representative is the legal term, and other market professionals. Probably you wouldn't read his books, but he's a great writer, and he has this wonderful saying: "Wisdom sold separately." Yeah, there's too much information. You go on, and of course, a lot of these websites, all they're trying to do is just trying to get more eyeballs. So they come out with, will Apple increase 20%? Or could GE fall 30%? Well, maybe. Yeah, it could. I don't know. Do you? Well, we have to get another article out the door, so we'll ask that question. We won't actually answer it because we don't know either. But it's something to read, and that's what's important. Slide number 7. We are going to embark upon ratio analysis. Financial ratios are the relation between two financial quantities expressed as the quotient of one divided by the other. Well, that's simple enough, right? And ratio analysis is the study of the relationships between financial statements and financial statement accounts. The study of relationships between financial statement accounts. Yeah. We're going to study the ratios. There is no one ratio, though, that can accurately sum up the overall state of a company. Each ratio must be considered in the context of all the information gathered. Plus, you must consider any ratio in the context of the industry the company exists within. So we're going to see some examples soon. So unlike the discounted cash flow models and the Gordon growth model, which basically kind of gave us a yes, let's continue studying, or no, let's not continue studying. The ratio analysis is more like a stew. It's more like a soup where we throw all these ratios together and come up with a more well-rounded picture of our company. And we compare that stew to another company that is in the same business, compare it to the industry it's in as a whole and the market as a whole. So it's a way to round out our investigation, our study, our research. Here are the common stock ratios, and some of these are review, because we've already talked about earnings per share, the price to earnings ratio, dividends per share, dividend yield, dividend payout ratio, book value. So some of this will be review, and some of it won't. And also we're going to dig deeply into the most watched market statistic, the price to earnings ratio. So let's get going. Slide number 9. Yeah, earnings per share. The net income divided by the number of shares. So we saw that Sprouts had earned, $260 million. But how much is that per share? Well, we have to divide by the number of shares outstanding. Earnings, and that gives us the earnings per share. So that's how we can think of our little one share of Sprouts Family Market or whatever company as a little factory, as a little business. And that one share is earning X amount of dollars. Earnings per share is the amount of annual earnings available to common stockholders as stated on a per share basis. We can think about each share that we own as a business entity in and of itself, earning X amount of dollars. Earnings per share is the subject of much discussion and speculation, especially with companies that are growing their earnings. Earnings per share is subsequently used in combination with the market price to compute the most watched, most important market statistic, the price to earnings ratio. PE, slide 10, bum, bum, bum. Yeah, it's a very simple calculation, folks. You take the price of the stock and you divide it by the earnings per share. Historically, PE ratios were in the 5 to 12 to 15, 14, 12, 15 to 20 was common for growing companies. Greater than 20 was unusual today and during other times when the markets were bubbly, so to speak. It was common. It is commonplace. It's commonplace today with many companies, and it was commonplace during the 1920s and 1960s, and then in the 1980s and 90s, and that is why many market pundits and experts, especially who have a long-term, long history perspective, say that stocks are just way overpriced. Well, so is everything else. If you ask me, real estate is way overpriced, and I don't know where is it going to end. I don't know. We'll see. The PE ratio also tells you how long it will take in years, assuming that there's no changes in earnings for the company to earn back its price. So PE 3, it's going to take 3 years. A PE 20, it's going to take 20 years. Not that that's important, folks, because everything's changing, right? The earnings are changing every quarter and the price is changing every day. So, but just it's something to think about, right? It's something to think about. And I will never forget, this was 1998 or 99 or something. eBay, which is still around, is one of the dot-com companies that actually survived, had a PE of 10,000. I said, this is going to end badly. Of course, it did. eBay dropped like 90%, but it didn't disappear, as most of the new economy .com companies, internet companies, and the like did after the bubble burst in 2000. So here are 6 different companies as of March 6, 2023. And you should know. Well, maybe you don't know Amgen. Amgen is a biotech company, drug company, biotech. Exxon, Faceplant. I'm sorry, now it's called Meta. Wells Fargo, General Mills, Bristol Myers Squibb, which is another drug company, but a different. This is biotech. This is more regular drug companies. And you see that the Exxon's a little low, and Facebook's a little high, but so is Amgen. But these go, look at Bristol Myers, it's 23. If you'd look at these last year, they would have been a lot higher, because what do we really need to do? We can't just look at a company without looking at their competitors. So looking at the energy companies, we see, they are commanding very low PEs. Investors are not too excited about the future prospects of the energy companies. I don't know why, and oil is not going away anytime soon. We talk about electric cars, but as if they're going to be here tomorrow. No, people are going to have cars that burn gasoline for decades. And what's the NA stand for? They have swung to a loss. British Petroleum has swung to a loss. So that's why you get NA, not applicable or not available. If they do compute the PE, it turns out to be negative, because you take a price divided by a negative earnings, you get a negative PE. Over here, we see that the biotech companies, Biogen is only 12.85, Amgen's 19.5, AbbVie, who are they? 23, and then what's this Illumina? Again, swung to a negative earnings per share. Well, just last year, they were around 60. Illumina is actually based here in San Diego. It's a gene sequencing company. So these are all biotech companies, and some of them very profitable, and Illumina was profitable until last year. The food companies, well, we see that General Mills is 16. That's pretty respectable. Kraft Heinz 20, Kellogg's 23, Hormel they make spam 24. If I were the CEO of Hormel, I would have a campaign, an email campaign, and I would say, "This is spam." Because spam email is supposed to go in the junk box or the spam box, but this is spam. We are the purveyors of salty sweet meats that clog your arteries. Anyway, they're very close, aren't they? But here we finally start to see some divergence here, with Facebook and Google being fairly respectable 20 PEs, Apple 25, Netflix 33. Of course, you had seen that a year or so ago before the 2022 downturn. It was it was really high. It was over 100 or so. And then what happened to Amazon? They've swung to a loss after many years of profitability. And there are a lot of people who are questioning Amazon's future as a whole company. Many people are saying Amazon should spin off their Amazon Web Services, their internet part that, believe it or not, you use when you use Canvas. You're using actually Amazon's IT system. Canvas uses Amazon's web service. So because the competition in the retail space, as it's called, the competition in the retail world, is gotten so fierce that people are worried about Amazon's continuing profitability in that. So, my goodness, we have to think about that. I tend to think they ain't going anywhere. People love Amazon. They love getting their stuff within a day or two. So I don't think it's going anywhere anytime soon. And look at the banks; they're fairly close to one another, right? And then here's where we start to see some real divergence. Bristol Myers Squibb 23, Merck 19, Pfizer 7, and Eli Lilly 44. Now, as we said, we don't make a decision based on just one ratio. But when we see something like this, why is Pfizer, which is a very good company, folks, only commanding a PE of 7, where Merck, one of their big competitors, is over double that, 19, and Eli Lilly is 44? To me, I like to think of this. If this helps, fine. If it doesn't, then don't do it. Use it. But I like to think of this as like a red flag. Come here, something. Come on over here. Something, you need to look at this because something ain't right. Not necessarily something isn't right. It's just something is different about this company than its competitors. And we need to understand that. And maybe it's something that might turn us away from the company, or maybe it's something that might turn us toward the company. Maybe investors believe X and we believe Y. Remember, we talked about that sixth sense that people might. Oh, we haven't talked about that yet. We'll talk about that later. My apologies. But so remember, these ratios are not a go, no go, continue or not continue, or sell, buy, whatever. They're a stew, and we must look at them in relation to all the other ratios that we're going to create over the next couple of presentations, and their competitors and the market as a whole, and their competitors, their industry, and the market as a whole. So, how can we account for the wide PE disparity between different industries and different companies within industries? Well, it gets back to the expectation of future earnings and dividend growth by investors. This is a quote which you probably can't read if you're looking at this on your phone or tablet. But it's from Jack Dreyfus, who was the founder of the Dreyfus funds, which are now owned by Bank of New York. It's from A Random Walk Down Wall Street, which is a book you should read. One of the two books you should start with, either Random Walk Down Wall Street or One Up on Wall Street. Take a nice little company that has been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's market, meaning the 1960s, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth burner, which nobody understands, A word that no one understands entitles you to double your entire score. Therefore, we have 6 times earnings for the shoelace business, 15 times earnings for the electronics and silicon, for a total of 21 times earnings. Multiply this by 2 for first burners, and we now have a score of 42 times earnings for the new company. And this is what was going on, folks. Throw a number up in the air. Tesla for quite a while was over 1,000. They're down to, I forget, 50 or so. As we said, Netflix and it was in the hundreds. Shopify was in the few hundreds, and Spotify and what's the one? Stitch Fix. The PEs were just outrageous. And when you see that, that's not to say you shouldn't invest in that company, but you better be ready. The parachutes had better be very large because there's a long way to fall. I forget exactly what the numbers were, but the last time I checked, somebody spent like $1,700 for Netflix, and it went down to $300 or $400. Yeah. Today, we don't talk about silicon and first burners and electronics. We talk about kleptocurrencies and NFTs and meme stocks and marijuana stocks. And the technology changes, people not so much. The next category, next ratio is the price to earnings to growth ratio. It's called the PEG ratio, and you'll see it. You can compute it. It's very simple to compute, but you'll see it reported. It compares the PE ratio to the rate of growth. The idea being that the rate of growth and the PE should be roughly the same. So if you take the stock's PE from the previous slide and you divide it by the 3-year or the 5-year growth rate in earnings, the predicted growth rate, if that's 1, that means the numbers are the same. That's basically all it's telling you, right? If it's greater than 1, it means that the PE ratio is greater than the growth rate. And if it's less than 1, which is unusual, it means the PE's ratio is less than the growth rate. Historically, a PEG ratio of 1 was desirable since it meant that the PE ratio equaled the growth rate. Anything above 1 was considered high. Now greater than 1 is commonplace, which is again why many pundits, market experts, whatever, historians say stocks are just too darn high. Dividends per share. Now let's review that. We discussed this before. It's a measure of how much dividends each share of stock will receive. We take the annual dividends paid to shareholders and we divide that by the number of shares outstanding. As we discussed, dividends became taboo during the run-up in the 1980s and 90s. Investors wanted capital gains, but the bear market of 2000 to 2002, many investors changed their minds, and dividends can now be discussed in polite company again. And you already know my feeling. I love dividends. Dividends don't lie. The dividend yield, again, this is something we discussed before, is very simple. Again, you take the dividends per share and divide it by the market price. It's readily available on any internet-related, finance-related internet website. This important statistic allows the investor to compare a company to other forms of investments that pay income, such as savings accounts or bonds. Traditionally, 4 to 6% was considered good. Currently, this needs to be updated. The S&P 500 is yielding about 1.78%, while Treasury bonds are up to 4%. And although many savings accounts are still pretty low, they have been coming up. They are paying 2, 3, 4%. If you remember your exercise in Chapter 1, I have to update this. My apologies. Some stocks are paying more than the 1.78% or so that the S&P 500 is currently yielding. And of course, many growth stocks are not paying any dividends because they're reinvesting the earnings, called reinvested earnings, back into the company. So we have to fix slide number 15, Frank. I will do that. Okay, slide 16. The dividend payout ratio. Again, this is another ratio that we discussed back in chapter 3. It's a measure of how much a company's earnings are paid out to shareholders in the form of dividends. We take the dividends per share and divide it by the earnings per share. And if you remember, more mature companies often pay out almost all of their earnings in the form of dividends or most of their earnings. Growing companies retain their earnings to support the growth of the company. So if you see a company paying out a large percentage of their earnings, it's probably a company that's very well developed, has plenty of resources at their disposal. They've already built their plants and equipment. They've already had their distribution systems and marketing systems in place. Whereas companies that are growing, they need those earnings to be plowed back into the company. So their dividend payout ratio would be a lot less. The book value per share, we discussed the book value per share. It's a measure of the net worth of a company on a per share basis. It's normally not that important. Why? Because a business is in business to earn money, and the business is worth more than just the assets on the books. And the example I like to think of is a pizza shop, because you look at a pizza shop, I mean, there's really not that much there in the form of assets. Maybe the oven is worth a lot of money, but the pots and the pans and the tables and all that stuff, it's really not worth that much if you were to sell it all off. But the fact that the business is in business and earning money, that's the real worth. So let's read. Book value per share tells an investor how much assets are behind each share of stock on the books. Maybe what's on the books might not be reflection of reality. In other words, if all the assets of the company were liquidated, how much would each shareholder receive? It is common for the actual market price of a share to be above the book value per share, since the company is worth more intact than if it were dissolved. Today, it is common for the market price to be far above the book value. Check out companies like Yum Brands and that's Kentucky Fried Chicken and Pizza Hut and Taco Bell, and you'll find that they have negative book value per share. They owe so much money that they actually are worth less if you were to less than zero if you were to sell everything on the books. So, but obviously, these people are still eating their food and paying a lot of money for this grease. I mean, this food, and so they are worth far more than their book value per share. Now, along this line, we're going to compare the book value per share to the price. Remember, we looked at the price to earnings? Well, let's take a look at the price to book value per share. This is a ratio of the market price to the book value per share. So remember, the price to earnings, price to book value is very similar. You take the, come on, sweet, talk nice to your computer. The market price per share divided by the book value per share. Given that the book value per share is often less than the market price, the price to book value per share tells an investor how far above the book value the market price is. If the price to book value per share is equal to 1, then they're the same. But what we said is very unusual. Today, 3, 6, 10 or more are not uncommon, and some are much higher. So think about it. Would you really want the price to go underneath the book value per share? What does that mean? That means that, assuming the accountants are reflecting reality in relatively well, the company would be worth more if it were liquidated, because you could sell off all the assets, pay off the debts, and walk away with money in your pocket. And that's exactly what corporate raiders, private equity artists, they go by various names, corporate takeover artists, that's what they do. They try to find companies that they believe the market value is less than what they could get if they were to buy 50% plus one of the stocks, and then they run the company then. Sell off all the assets, pay off all the debts, and walk away with extra money in their pocket. Now, you have been working for this company for 22 years, and it's been hard times, but say you're bringing home a paycheck, and now these takeover artists come in and whoosh in and whoosh, put the company's put out of business, and everybody's given a handshake and maybe a few months' salary, maybe not. How would you feel? You wouldn't feel very well, and you would get very angry, and you'd go to your your Congress representative, and say, "We don't like that. How could they do this to us?" Well, it's capitalism, and the economists and of course, the corporate takeover artists, if they deigned to talk to you, the little folk, or you and me, they would say, "You don't understand. That capital, that company, that real capital, the plant, equipment, all the other assets, and the human capital, you as an employee, were not being utilized efficiently. We need to plow that capital under." Think of a farmer. We need to unlock that capital and use it in better ways. But that doesn't sit well when people are hungry. And that's why we have unemployment insurance. Okay, don't let anybody tell you we have unemployment insurance so that we can let people not work. That's not what it's about. We want that company to go under. We want those people to be utilized in a better situation. Hopefully they'll get even better jobs, maybe not. That's an issue. Capitalism's not perfect. It might be the absolute worst economic system ever developed by humans, except for all the others. So there, think about that. And we're going to continue this with price to cash flow, remembering that earnings are one number that we relate to the IRS, but how much money actually came in the door, that's the cash flow. So you do the exact same thing. You take the market price per share and divide it by the cash flow per share. And as we said, cash flow often differs from earnings per share for several reasons, but the poster child, the one that we most think about, is depreciation, because it's not an actual cash expenditure. Nobody wrote a check to depreciation. And then you hear people and investors and others talk about good quality earnings versus poor quality earnings. During the internet mania, many companies were reporting record earnings. At the same time, their cash flow was negative. The amount of money in their checkbook was going down. How could that be? What was going on? Well, one example is Lucent Technologies. Lucent Technologies was spun off from the old AT&T. It used to be called Western Electric and Bell Labs. They're the people that brought you the transistor and Unix and a bunch of other things. And they spun it off. They made the best telephone equipment in the world. And during the 1990s, when the internet was taken off and cell phones were all the rage, Lucent Technologies was just selling equipment like crazy. They were making record earnings. How come their checkbook was going down? Well, it's very simple. The companies they were selling all this equipment to were brand new startups that had no track record, had no earnings, and so no bank would lend them the money. They couldn't go to the bond market. So they went to Lucent and said, "Would you sell us $2 billion of equipment? Oh, by the way, we'll pay you $50 million a year for the next 40 years or whatever." And Lucent, of course, was very happy to sell new equipment. But what happened to these companies in the next few years? Bang, they disappeared. Lucent got the equipment back, right? Because they were the bank, basically. But now it's obsolete and nobody wants to buy it. Lucent Technologies almost disappeared. Poor quality earnings. So that's why we love to dig deep into those balance sheets and those earnings statements and the cash flow statements and see what's going on here. How come these guys are making record earnings and their checkbook balance is going down? And our last one is price to sales. Price to sales, same idea, price to earnings, price to book, price to cash flow. Historically, a higher price to sales ratio suggested a higher sales growth, and a lower price to sales ratio suggested a lower sales growth. You take the market price and divide it by the sales. During the internet mania, many analysts use price to sales instead of price to earnings. Why? Because many of these new high-flying technology companies never generated any earnings, and it wasn't likely they would generate earnings that would be cash flow positive for quite some years. And of course, we know how that ended. Okay, so these are the common stock ratios, sometimes called the market ratios, and they're mostly readily available. In our next presentation, we'll take a look at some that are commonly available and important, and others that are not so commonly reported, but still important for us to calculate when we do our analysis, when we do our investigation and research, and compare our potential investments with their competitors. How was your day at work, dear? I know it's not that exciting, but it's important. So stay awake, and we'll see you in our next presentation when we take a look at the profitability and the liquidity ratios and the activity ratios and the solvency ratios. And we are so proud of you. Thank you so much for being in our class. Think about how much you've learned.